What's going on, penny boys and gals? It's your boy, What the Duck here, and it's time for another trading class video. So this is the Trading Strategies Week. We went over Finviz.com, Webull, Robinhood, Investopedia, Investing.com, TradingView. Tonight we'll help with your trading strategy, being float, halts. We'll be going over dividends, splits. Let's just get right into it. We have a lot to cover today. So first up is floats. A float in trading refers to the amount of common shares a company has issued to the public that are able to be traded by investors. So you can find the float by taking the company's outstanding shares and subtracting it by the restricted shares. So if stock XYZ has 15 million total shares, but 5 million of those shares were restricted shares, the company's float will then be 10 million. The float shows us how many shares are available for trading by the general public. Shares purchased, sold, or shorted do not affect the float because they are just simply a redistribution of shares. The only changes that affect the number of shares available for trade change the float, so not secondary market transaction or redistribution of shares. Another reason that's good to find the float is because it can show you how much sway or control of the stock movement that the insiders have. Float does affect how volatile a stock may be. The greater the float, the less likely there will be high volatility. The greater number of shares available to trade, the less volatility the stock will experience because the harder it'll be for a smaller number of shares to move the price. As far as short floats go, the short percentage of the float is the percentage of a company's stock that has been shorted by institutional traders compared to the number of shares a company's stock that is available to the public for trading. And you can find that out by getting the shares shorted and dividing that by the shares available for trading and then multiplying that by 100, and that is your short float percentage. So typical traders or normal traders like us, are sometimes late to get into trades or trends compared to institutional traders. If a stock is getting heavily shorted by an institutional traders in general, then there may be an underlying negative fundamental which we just might not know about. If a stock is reaching a high short percentage, around 40%, then it might be a good idea to research the stock because there might be something that you don't know about that could make the stock price drop, but those institutional traders do know. So the short ratio is the number of shorted shares divided by the average daily trading volume. A short squeeze can happen if the price of a stock with a high short interest begins to have a strong upward trend. So to cut their losses, short sellers may buy shares to cover their short positions, causing the stock price to rise temporarily. Short squeezes are most likely to occur in stocks with small market cap and a small public float. So where do you find the floats? Well, on the Webull app, once you're looking at a stock, you click the volume in the top right corner, and this will bring up a tab with the market cap, percent turnover, percent range, as well as free float and shares outstanding. And the free float will show you what the stock's float is. You can also go to Finviz.com, and if you look right here where my mouse is on the right bottom right hand corner of the screen, you'll see the shares outstanding, the shares float, the short interest shares, as well as the short interest ratio. A dividend is a distribution of profits by a company to its shareholders, meaning us. When a company earns a profit, they are able to pay part of it as a dividend to shareholders. Any amount not distributed to the shareholders is then reinvested into the company. That's called retained earnings. The current year's profit and the retained earnings from prior years are available for distribution as a dividend. A company is usually not allowed to pay a dividend out with its capital. So most dividend payments are quarterly in the US, semi-annually in Japan, and annually in Germany. However, they can vary. The dividend shows you how much per share the company is paying each shareholder, and that's the dividend payout. The dividend yield is expressed as a percentage, and it's a financial ratio, the dividend divided by the price, that shows how much a company pays out in dividends each year relative to its stock price. And in the handout, the PBU handout for this class, I have a link to a dividend calendar where you can find out where all the dividends are happening. You can also go to the Webull app or Finviz.com and find the dividend and dividend yield the same way that you would find the float. So next up is trading halts. So a trading halt is a temporary suspension of trading for a stock. This usually happens in anticipation of a news announcement to correct an order imbalance, a technical glitch, or due to just regular concerns. So when this happens, open orders might be canceled, but options still may be exercised. A company on the stock market agrees to pass on material information to the exchanges, the stock exchanges, prior to announcing the news to the general public. The stock exchange already knows this. To make trading more fair, the exchanges may choose to halt trading for that company right before the news is released. halts, and halts may also be triggered by severe down moves in what is called circuit breakers or curves. And this is just to make trading more fair for those. Stocks can drop real hard real fast, or they can rise real hard real fast. They want to make it fair so everyone can get in or out of the stock. So next up is... a stock split is when a company divides or multiplies the shares of its stocks into new shares. So a reverse stock splits is when stock divides their shares. A traditional stock split, also known as a forward stock split, which is what Apple and Tesla just recently did, is when they multiply their shares. Some common forward split ratios are 2-for-1 or 3-for-1. So for a 3-for-1 split, you will have 3 shares for every 1 share you held pre-split. However, the split won't triple your money. For a 3-for-1 split, the price of 1 share of the stock will then be divided by 3. So if you had 10 shares of a $30 stock, meaning you had $300 worth of this stock, and it had a 3-for-1 split, you now have 30 shares of a $10 stock, which is still $300. So why does this happen? Well, most traders feel more comfortable buying 100 shares of a $10 stock than they do a 10 shares of a $100 stock. So companies do forward splits to reduce their prices to more trader-friendly prices. Some companies do splits to create more outstanding shares because it creates more liquidity. This could narrow the bid-ask and make it easier for traders to buy or sell the stock without it making a huge impact on the stock price. Some reverse splits happen when a stock is trying to bring their price over that $1 range so they can continue being listed on the current stock exchange that they're on. So next up is the Webull financials. So first up we have the EPS. So your EPS is the earnings per share, and it's the company's net profit divided by the outstanding shares of the common stock. So this usually shows the profitability of the company. So the higher the EPS, the more profitable the company is considered to be. Then you have your return of equity. It's the net income divided by shareholders' equity. And shareholders' equity is equal to a company's assets minus its debt. It's considered the return on net assets. Return of ROE can be looked at as the profitability of a company in relation to stockholders' equity. So a good ROE depends on the industry. You can consider an ROE near the long-term average of the S&P 500, like around 14%, as good, and anything less than that as typically bad. However, it really depends on how other companies in the same industry and sector are doing to compare. So it's good to compare your ROE to other companies that are in the same sector, same industry. The ROA is the return on assets. This shows how well a company utilizes its assets. It's found by dividing the net income by total assets. Unlike ROE, the company's debt is taken into consideration when determining the ROA. So the higher the ROA number, the better, because the company is earning more money on less investment. So the best way to use ROA is also to compare it to similar companies, or by comparing it to a company's previous ROA. BVPS is the book value per share. The book value per share is the common equity divided by the number of outstanding shares. It shows the net asset value, which is the total assets minus the total liabilities per share. If a stock's price is undervalued, it will have a higher BVPS. So this is used to evaluate a company's stock price. You also have CFPS. The cash flow per share is a measure of a company's financial strength. Due to the CFPS, representing the net cash a company produces, is viewed as the most accurate measurement of a company's financial well-being. So you have your net income. Net income is the profit a company generates. You have your total revenue, which shows the total sales and revenue. And the operating income shows the amount of profit a company made after deducting expenses, which is wages, depreciation, cost of goods sold. So that is the operating income. The balance sheet and the cash flow we will be going over in PBU Advanced. That is the end of this video. I also, on the handout, I have a link to the sec.gov site. I have a little explanation of how to use it and what you can search for, and that will be very helpful as well, another good trading tool. But yeah, so that's the floats, that is the dividends and the halts, stock splits, and that is that. I hope that y'all enjoyed the class. I hope you guys are enjoying PBU in general, and I hope that you all make some bread.